Okay, I will present Redfish Long-Term Capital, that is an holding company, an industrial holding company. We love to call it like that because we have a very great path in our career of the manager in industrial companies, and our approach is to build up real values in the companies that we acquire. The value of our investments within the 5 years that we are running the company, from second half of 2020 till now, is about 120 million evaluated. It's composed by a component of equity stake of 51 million and a leverage of 32 million. The rest is the value added that we created in the group we invest in. Our horizon of timing of investment is the mid-long term, so we don't have a compliance, a rule like the private equity that we need to realize the company in 3-4 years. And so the scope is to take the right time for each asset. As we will see in our history, we had some cases where we exit in 2 years, and other cases that we stayed longer time, and we project to stay for longer period in the company. As you see, and we will go deeper, we use leverage at a very low cost compared to other holdings, because we consolidate some of the business, and the banks and the market give us a premium in terms of cost of debt. We are able to pay on average 6% per year this kind of net, the PFN we raised, and this gives us also a leverage on the equity return of investment that we expect to double in 4 or 5 years. So I don't know why it's not going down. Okay, we do like that. So the main issues and the main characteristic of long-term capital is that is basically an industrial holding listed many in Italy, but also on the German with the double listing approach. So any industrial or financial investor in Germany can more easily buy the shares directly in your country. I mean that the attractivity that we have is that the current price of the equity just represents the 50% of the net asset value evaluated in our research. Unfortunately, of this, the result we had is that we usually imply a strategy of buying companies at the low level of enterprise value EBITDA. Usually we have an average below 5 times EBITDA, and and this kind of approach allow us to buy well and wait the timing for the exit. The main exit we have in mind, as we see in the case history, was made at 12 times EBITDA. So we made also such a kind of mismatching of multiple, waiting the right time for the exit. The reason why we buy at this low level is because our approach is also as a consulting company. In our profit and loss, if you go in detail, you will find such like 750,000 euro of consulting fees. That is the way we approach the company. These fees are composed by a flat level, usually 30,000-40,000 per year to consult our company in M&A, in restructuring, in developing discount cash flow model or treasury for manage the net, I mean, the PFN better, or any other kind of financial support they need, and a part of success fee that we agree with them as let's say 2% of the value that we give them by assisting them in the acquisition. Acquisition is part of our build-up strategy in each of the company we own. Our objective is to make at least one add-on every year for each participated company in the company. We have 7 participated, and we will see in detail in the next slides. Our objective is to buy at a very good price. Usually, we don't never go lower than 2 million, but we have also champion companies like Polyeco, as we will see in detail later, that now run a business of 250 million euro turnover with 55 million of EBITDA. So it's really a large size. We entered at 4 times EBITDA in that company due to the fact that the owner thought that the approach of Redfish, giving them time to understand, to manage the right, to internationalize, was the right approach. We entered with just 15%, so they are not devaluating the whole company. We know that the value of this company is at least 8 times EBITDA if we should go on the market for the 100%. And so our investor can enjoy of this mismatching of the multiple once we will decide to exit the company in the future. Usually the company we target are family-owned small company. They never had an approach of finance guys, private equity, or other things. Their objective sometimes is an exit in IPO. We will see a case like that. And we can guide them having a deep experience in listing companies, as we have also another part of the group that is dedicated to listed companies, that is also listed in Düsseldorf, that is a Redfish listing partner. So coming back to Redfish long-term capital, wait a moment because it's not working my computer. The investment process is very easy. Origination, we get a lot of mandate from advisor around Italy. The first investment usually is always on an Italian company. This is the history that we had because it's a market that we are more familiar. But the scope of our investment is to expand the company internationally, especially in Europe. So most of the companies we invest, then they came to a more European scope. We invested in France, in Germany, in England, in Spain, also in Turkey for some sourcing reason. And so our strategy is to help this company and this family company to become international, more appealing for the international market, and then to guide them in the exit. Usually after origination with the lawyer, we run a closing, especially in for our strategy. There is always a earn-out and some kind of adjustment of the price during the next year or 2 years, sometimes 3 years, like in the case of Thesis, that is an aerospace company that we had a 3 years earn-out, waiting for the results for the business plan. So we are able to guarantee the fair price to the seller and also for us, for the buyer. Sorry, because every time I use the computer is mismatching. Also, 3 cases of success. Matic Mine, we entered at 6 times EBITDA, was a company of about 26-27 million EBITDA that we entered in 2020. We grew dramatically with 5 acquisitions during our management time. And in 2022, we had a 48 million EBITDA, and we attracted the attention of CVC Capital Partners at that stage because we had a special add-on of 20 million. So the size of the company was going over 60 million EBITDA. At that point, CVC was able to offer us 12 times EBITDA. So just in 2 years, we made 2.5 times the invested capital. There was exceptionally, it was information technology. Maybe we'll go back to information technology in next acquisition. Obviously, this was a very special case. We have a majority of Inter. We entered in the company when it was 25 million turnover. We bought the 100%, actually the 96%, and then we acquired the 100% later. It was a 3 million EBITDA. We made 2 add-on of about 30 million, and then we have 30 million of turnover, and we helped the company to grow internally, and now it's over 66 million of turnover. In that case, we don't plan an exit. We now expect to arrive to 100 million, both with internal growth and the further acquisition this year. And we have the majority third party in railway business, working with Alstom, Hitachi. We just won together with these guys the Washington Underground for the train manufacturing that will start in 2026 and will last in 10 years. And so we are implementing to open a new company in United States. We already are based in Miami. We will move near Washington to be more close to the Hitachi and Alstom facilities. And this is a majority stake, so you will find the numbers within the consolidated balance sheet of Redfish Longterm. We think to keep this company for at least other 3 or 4 years. We expect to arrive to 200 or 300 million turnover. At that time, we will see what will happen in this sector. We also have a minority case. SolidWorld is the Italian leader of 3D digital system. Someone that invests in shares are familiar with this company. This is listed in Italy, but often comes to Germany to present themselves. We invested at about €1 price. We sold a part of the company when it reached a very high evaluation of €6 per shares. We kept the company in portfolio because we believe in the long term there will be satisfactory results, even though our exit strategy was to take the company in the IPO, and that happened. We have a big team composed of me, Paolo Pescetto, and Andrea Rosotti as CEO. And we have also representatives of family that invested in the company, like Luigi Pacella Grimaldi. Grimaldi is a very big company in the shipping, and it's about 8 billion assets and 6 billion turnover, and is part of the investor. Raffaella is representing a family office. Massimo Lapucci is an independent manager coming from many kind of foundation and pension funds and so on. Francesca is founder with us and is part of Bazzoli family. His father was is president of Intesa. This is a bank, and Paulino is somebody coming from bank, and under the line the team. We usually, with internal team, we had industrial expert. This is part of our added value to the company. As you can see, within the 7 company we have in portfolio, S.p.A, that is a company that is making chimneys. We bought 2 companies in England. We had them to grow in Europe. Is the Italian leader of chimneys, and we are looking actively in Germany. I don't know if there is a question. Do you see the environment in Italy for upcoming IPO after 2 very difficult years? I see very gray the environment. I don't see that there is some movement in the brief time, even though in this month of May will arrive the government fund that will inject something like 1 billion euro in the especially focused on the small companies, so probably also the Redfish Longterm Capital shares will benefit of that, but I don't think that will be a great change in the total environment of IPOs. We don't plan to make IPOs. As a matter of fact, Polieco property would like to make an IPO, was projected for July 2025. Everything is perfect for making the IPO. The company is performing very well, but we still see some difficulty to make a very good IPO, at least at 6 times EBITDA. If we go to sell the company, we know that we can reach 7, 8 times EBITDA due to the perfection of this company and the active strategy that we are doing in acquisition. It's not neither 1 year that we bought the company in June 2024, and we already bought Picenium Plus, that is a 9 million EBITDA company, and now we are focused with different company with 5, 6 times 5, 6 million EBITDA. So we'll go future in acquisition. There is not cash problem. Polieco has a free cash of 50 million, and so they don't need the IPO for pushing the acquisition strategy. They are giving us 10 million of dividends. Obviously, we have just 15%, but it's 1.5 million of dividends from Polieco every year. So we don't need IPO. We don't need the exit. We don't need, a specific. We wait for the right time. This is the answer that I feel I will give to the one that gave the question, and I thank you for the question. Are there differences in valuation from Italy to Europe in case you are looking to buy a private company? Yes, dramatically. Especially in Germany, we see that there was not a correction in multiple. The fact is that usually we find companies that are willing to be sold at 8 times the EBITDA, even if financially are not so solid like the one in Italy. In Italy, usually there was a very big differentiation of multiple. That's why we would like till now to start entering in Italy. Even though we are looking to Germany for 2 reasons, because the market is very depressed, so the EBITDA is very thin, and where we can see high synergy from the combination of the single group like S.p.A, like Polieco in particular. We know that even if we buy at maybe 6 times EBITDA, 7 times EBITDA, maybe we are able to double the EBITDA in 1 year with synergies. For example, S.p.A, Inox have a fantastic source of chimneys in Turkey, and what happened in UK, we took 2 companies with 0 EBITDA, so we paid a very high multiple of EBITDA, considering that was 0 the base, but immediately it came out 500,000 EBITDA, and we planned 1 million EBITDA in 2 years. So okay, we pay maybe higher price. In France also, the multiples are higher. In Spain and in Poland, equivalent to Italy. I mean, they lowered, but we are looking in that way. We don't look at the private equity as they are add-on of Italian company. Another question, what about your dividend policy in case of a successful sale? Could you pay an extra dividend. We will consider it. In any case, even this year, next week, we will pay something like 3.54% of dividends every year. So the only year that we didn't pay dividend was 2024 in the history of Redfish, because listening to asset manager that was the more near the company after the investor more active near the company, they preferred that we made 2 million assignments of 2 million euro in self-acquisition of shares, buyback of shares. We made this 2 million acquisition buyback, of which 1 million was implemented and 100 million we left for this year. But we think, looking at the private investor, that the dividend policy will be more sane. And so from this year, from this month, you know that in Italy we approved the balance sheet end of April. So the end of May is the cutoff. We will pay constantly the 3, 4, 5% of dividend. In case of sales of one business, maybe we made an extra dividend, maybe we make an extra buyback. Everything is available. I mean, you know that the only incentive of the management, we don't have management fee, we don't have carried interest, we have a premium on dividends. So if you this was made to align the interest of investor to the management team. So if the assembly, we propose to the assembly, that is 95% listed, so we are a public company. If the assembly approve the dividend, we are happy because we pay our bonus on that base. So this was the complete alignment. Obviously, if we some of the incoming capital maybe could be designated to an extra acquisition, even though now we are more and more active implementing a club deal approach. For example, Polyeco is a 31 million investment, of which 10 million was coming from Redfish Longterm Capital and 21 million from the market, of which 14 million from other investors that pay a carried interest to long term, and 7 million from a bank that is already been repaid from dividend. Then we make an asset share deal, and so in 1 year we repay the bank, and so now all the rest of the dividend in Polyeco will arrive in long term. Another question: what about your dividend policy? Okay, what about your shareholder structure and free float, aiming to increase it? In this moment, we decided not to increase the shareholding structure, because we exit on the market with a bond that pay the 6% of interest per year, with a monthly based payment of interest. It was a great success. We already placed it within our shareholders and other shareholders, and it was a complete success. We gained 50 million, of which was designated 5 million to reimburse more expensive loans. So we optimized the leverage structure, and 10 million are available for new deal. We think to make a couple of deals with this amount. Is a bullet, so we reimburse it in 3-5 years. And it was very, very attractive because it was, and because Redfish Longterm Capital has a very good, I would say, rating is A2, better than the Italian state, because due to the diversification, the optimum cash flow, the equilibrium we have of different sectors. So due to this, the 6% fixed for the next 5 years interest was considered a very good bond. We placed it directly. We didn't pay commission to bank. We just had some communication on internet, and we raised this big amount. If we will find a fantastic deal, maybe, and we will not exit some of this portfolio company, maybe we will see, not in the brief time, maybe after, when we will implement the investment of this extra 10 million we raised. Probably, as we made with Matic Mind, an exit that was extraordinary. You know that the average time is 4 or 5 years. So we expect the first business we invest in 2020, 2021 will arrive to an exit strategy within the end of this year and especially the next year. So we expect that we start an exit and reinvestment partially and extra dividend starting from the end of this year and the next year. But you know, even the only company we have an agreement for exit in starting the first at the approval of the balance sheet of 2025 is Tesi. Because we invested with the Invitalia, that is government fund. So in that case, we have an agreement for an exit strategy very precise. That is our aerospace company that is performing very well. All the other company, we don't have a precise exit strategy, but we work together with entrepreneur to understand the best moment of the market. Now, the IPO is not a valuable exit strategy, but you never know. If the market change, we will evaluate also that kind of strategy again. Well, very good.
Looking at the time, just okay. 1 minute left. So yes, maybe use that time to wrap it up and just give the investors one more time the investment case. Why should we all invest in Redfish long-term capital?
Okay. So I will take this slide. So the intrinsic value of the companies was evaluated 2.27 euro per share. As I told you, there is a big difference with the current price. It is about 1.19. So we have about the 100% potential increase. And this is the portfolio. All the companies are growing and are performing well. And then you have some of the company here. I don't think is important. So I will take the opportunity. Polieco is a fantastic deal, as you see. If you think that is evaluated in our portfolio 4 times EBITDA, is a 51 million EBITDA company, you know that this kind of company, the real value is really higher. I will respond. Defense is something that we already declared that there is a target that we discussed. We hope to arrive to a conclusion. Is a very complicated deal. Is more than 2 years that we are negotiating this kind of company, because you know the golden power and all the stuff, but is actually something that we are more than looking at it, and we hope to give you the good news before summer.
Paolo, the time is already up. Thank you so much.
And I thank you very much.